Alright everyone, let's finish up chapter 10. So let's talk about normal and non-normal cash flows. So normal cash flows basically have a series of positive cash inflows. One change is assigned. You have a negative at the beginning and then positive throughout the life of the project. When you have two or more changes or a negative cash flow in a future year, that's going to be a non-normal cash flow. Here are some examples so you can see in the first example a negative and positive all the way throughout. And then you have the second, which is non-normal. You have a negative at the beginning, a bunch of positives, and then a negative cash flow. The third example, it's a little different, but it's still normal. You have 3 years of negative outflow and then positive cash inflows. One example of that would be Amazon. They had many years of negative cash outflow without any positive inflow, but now we have seen that turn around quite a bit, right? So there are some examples. Now you could have positive inflow in year 0, 1, and 2, which would be very uncommon, but it could happen, and then it turned for the worse, right? But then the last example, you can see we have a negative, a couple years of positive, negative, positive, negative. So that should be pretty simple. So when there are non-normal cash flows and more than one internal rate of return, we want to use the modified internal rate of return. So let me pull back up our Excel file so we can quickly see this one, and that was slide number 31. Alright, so simply you want to lay this out again like I've showed you. You've got your cash flow here at the beginning, and then your cash flow in year 1, cash flow in year 2. So you're going to do the modified internal rate of return. I'll show you the bigger version of this formula here. So we've got the values. We're going to grab those numbers. We got our finance rate and our reinvestment rate, which is 10%, and that's going to get us to the 5.6%, which is right here. So real quick and easy in Excel, you can get to that answer as well. Alright. So, do we accept the project? No, we reject it because the modified internal rate of return is less than the standard rate. All right, so that would basically mean the net present value is a negative, so that's a big no. Alright, so we have projects T, which is a 2-year project, and F for 4 years. We're looking at these side by side. Okay, which one would we want to do? Seems like a pretty obvious answer, but when we get down here we see, but wait, T can be repeated. It can be done more than once. So in that same 4-year period, it can happen twice. So how do we calculate that to see? So we can do a replacement chain. So we can just basically generate that second occurrence, so that project, and we can see that right here. Right, so it's pretty easy to do. If you want to use the timeline, if that's your easier way, and we can see that the net present value of 7.54 is greater than project T, which was $6.19. Like most things, you can do it in Excel as well. I've got that here for you. It's a little bit complicated, but not too bad. You're just going to do the net present value of both of these instances. So if you think about it, let me pull it up this way. I don't want to see that. I want to see this, please. Well, I don't know why it doesn't want to show me. I guess I've got to be in there. There we go. Alright, so we've got our rate. That doesn't change. We've got our value in year 1. That didn't change. Our value in year 2, however, did change. It went from being a positive number to a negative number because we're incorporating that cash outflow to have that happen for a second time. But then we've got our cash inflow here in 3 and 4. So that's pretty simple. You just combine the two in the formula and it's going to give you the answer. Right? So we can see that 7.54. So hopefully that makes sense. You may have to compare this side by side with the formula, but you can see you've got the 60 that we had in there as the first value, and then the combination of these two, which was your negative 40, and then the 60 and the 60. So that got us to that net present value. Now, if in year 2 the cost of doing this investment or this project went up to 105, well, that changes everything completely. And you can quickly change that into your calculation and see that the new net present value would be 3.4. which is less than the value of t. So you would want at that point to change which project you would want to do. All right, let's talk about economic life versus physical. So we're going to consider another project with a 3-year life. If terminated prior to year 3, the machine will have a positive salvage value. So would we always want to use a machine until it's just broke, it can't be used anymore? Or are there times where we want to get out of a project or replace a piece of machinery to get some value out of it from a financial perspective? So let's look at it. So side by side we can see here the current value, right? It's 5,000, then it goes down to 21, 2,000, and 1,750. Then you've got your salvage value over here. All right, so we can use it all the way through year 3, but we don't have any salvage value. So how would we figure out what's the best way to go? All right, so let's look at the cash flows under each one of these situations, and we can see what happens. All right, so now let's do this. Let's look at the net present value of each one of these. So the net present value for the 3 year, so we just use it for 1 year basically. If we use it for all 3 years, our net present value is negative $123. If we use it for 2 years, we're saying $215. If we only use it for 1 year, obviously that doesn't make sense. All right, so not too difficult to figure out. I don't believe we had an example on that one. But it's not difficult to figure out. You can get the net present values of those different cash flows pretty simply. But just wanted to point out the example that there are times that you don't want to use a machine through the whole life of the machine. You want to maximize your profit by getting that salvage value. Okay. So lastly, the project is acceptable only if operated for 2 years. We just started that. So I will quit with that. Hope this was helpful. And again, I attached the Excel sheet to the last set of PowerPoint videos. So you should have that for your use. Please feel free to reach out if you have any questions on this week's work. And I hope you guys have a great remainder of the week and the weekend. Thanks so much.